If there are any flaws in the U.S. financial system, and there might be, Federal Reserve Governor Daniel Tarullo was on the warpath to find them. Tarullo was appointed by President Obama back in January to the Fed Board of Governors. Writing on the Fed's mandate to stabilize the financial markets, he's attempting to change the way and address potential threats. For more on Tarullo's plan, let's bring in Bloomberg's Craig Torres. He has been following that story. Craig, how is the Fed changing its approach to supervision?
Well, it's interesting. We just had the president a few minutes ago talk about a pandemic. So what the Fed's trying to do is find pandemics. And maybe the example would be, up until now, they're very much, their examination process is very much bank specific. So you say, this bank has a couple of these risky loans, but it's earning money, it's well capitalized, so we think they're safe. What he wants to do is have a system that detects lots of banks leaning in the same direction, something that can pull out behavior and say, hey, in the aggregate, we've got 10% of the banking system that's investing this way, looks risky, what should we do?
Craig, how does this all factor into that too big to fail persona that some of these banks have?
Well, let's just say that banks in the future, this is an agency that hasn't been explicitly charged by Congress yet with financial stability, but knows that it's on the hook no matter what. Whatever they devise, the Fed will be a major player in surveillance going forward. And banks are going to feel the love. They're going to get that big bear hug. They're going to be looked at a lot more aggressively by the Federal Reserve. And then the question is, what do regulators do when they find stuff? We don't know. In the past, they didn't do much. They found a lot of stuff, and they didn't do much.
Right.
So,
is this going to cause any tension? Because as we'll recall, Treasury Secretary Geithner, he fought an earlier attempt to strengthen the role of the Fed's Board of Governors in bank supervision. Will there be any friction here?
Well, the Fed's an unusual organization that has this. It has the real power of supervision is in the Board of Governors, but all the expertise is in the reserve banks. So naturally, there's going to be some tension. But after being through what the economy's been through and seeing the losses, I think there's definitely a unified goal at improving supervision. And then it's a question what the leadership of the Fed wants to do with the information once they have it.
But did the Fed fail in stopping the buildup of risky mortgages because they lack the will and or the right design for supervision?
All I can say is in my story today, I quote Vincent Reinhardt, and he said, we saw these risky mortgages, and we said, the market seems fine with it. The credit default swaps on these banks say there's very little risk. And so we thought the market's right. So according to him, the decision maker said it's fine. I don't think that's going to be the same kind of decision they make in the future.
Craig, we have about 20 seconds. What does it mean for banks?
It means that the regulatory oversight is going to be much more aggressive, and that possibly, they'll be asked to put more capital against risky positions, and returns could be lower going forward.
Bloomberg's Craig Torres joining us from Washington. Craig, thanks.